Now, I made a video just now about tax equity investors and allocation of tax benefits and flips and all that. And frankly, that's not so bad. I wanted for about a year to finish this up because I want to get a comprehensive analysis done. And unfortunately, what we did was just a small part of the process because here's what happens. I'm going back already. There are constraints on the ability of a tax equity partner, the investor who puts all their money up to get all the tax benefits out. They might not be able to get them all out. And the reason they might not be able to get them all out is because if the tax authority decides, well, you don't have any real, I like to use skin in the game, but that's not what they do. They said if it's passive, if you don't have any real risks in this project, you don't get any tax benefits. And the way they measure this is with capital accounts. Let me tell you what they are. But before that, let me give you my caveat again. I'm not a expert at this. I'm not a tax accountant. And these arcane things drive me nuts. And there's a financial modeling theme here. I have seen, and I'm going to show you some real models, they get so ridiculously, I don't know if I want to call them complex, but long and detailed, and who knows what they're doing. It's very difficult to read. And I've seen some of these financial models of PPPs where they basically, if you're investing in a school, every single pencil you buy, you have to put in, and the thing looks so long and so elegant, but it's just a bunch of stuff to derive EBITDA and CapEx. And now a similar issue exists here. We're going to talk about capital accounts, and they have something called remedial depreciation, 704C, minimum gain, stop loss reallocation, excess distributions. And some man said, they have to have monthly 704B capital accounts and tax bases. And they have to do with, you have to put this in for every single investor in the partnership as a whole, and by the time you're finished, oh my gosh. Okay, but I'm going to try to boil it down and talk about what's meaningful and what are the real issues. So this video will have a little bit of Excel, not too much actually, and it'll talk about some philosophical issues about how detailed you should get and where you should put this, because a lot of times you miss the real issue. And what we're going to do is model these things called capital accounts. That's just equity capital. First time I thought, I said, what's our capital account? Okay, and if you include all the equity, it's like minority interest and majority interest. You put the dividends everybody gets, the income everybody gets, and the balance sheet should balance. It might not for one little reason, by the way. And then somebody said, and this is probably true, all of these tax things have something called tax absorption. That means, I suppose, you can't get all the taxes used. And then, I'm sorry, my dog's giving me problems here. They're not mine, my son's. There are different ways of measuring equity capital, and that's what I want to talk about here. There's something called a capital account, and I don't know what to call this. This is 704B, whatever in the heck that means. We'll talk about that one, or something called an outside basis. So the first thing you got to do, instead of just going and reverse engineering a model like I did, or trying to look at a model and try to understand the little formulas in every single line, you have to understand what is the importance of these two things. Okay. And okay, here again, everybody keeps track of two different equity capitals. I just try to clip as many examples of this writing I could. Equity capital accounts are different ways of measuring the equity. Oh, God. If the capital account becomes negative, then that's the problem. Because the issue is, I'm repeating myself, but I think it's worth repeating. If it's negative, that means that you don't have any real stake in the game. And here's somebody else. This is the Deloitte presentation of somebody. They said, look at this below. Losses are limited to positive capital accounts. So you can't get a tax loss, a loss on your tax depreciation, if your capital accounts are not, and they use the word S. This is plural. This is plural. So you have to have two capital accounts. That's what's a little bit confusing. Okay. Now we need to understand the difference between these two capital accounts before we delve into this modeling. Now, there are capital accounts for each investor. And there are two different, so at least there are four capital accounts. And then you can compute an aggregate equity capital account for the entire partnership. So now we have 6 different big capital accounts to throw in our model and confuse people. But there's only one that really matters. We have to figure out the capital account that causes the constraint, that causes you to not be able to realize all the tax benefits. Before you get to modeling, you've got to understand that's what you're trying to measure. Okay, and here the difference between the two. A partner's regular old capital account, well, any capital account, measures how much you own the company. That's just equity. That's just any equity investment account. Add the income, subtract the dividends, get the opening and closing balance, and figure out how much equity you put into the company. Any equity account does that. Okay, and here I said that even right here. Okay, and then now we have two different methods. This one thing that's called outside basis, that's what I'm going to talk about now. And I'm going to make a little model of that. This uses taxable income, not book income, and that means it uses accelerated tax depreciation to compute income. We have EBITDA, we have no taxes, no interest, because I'm assuming no interest, so EBITDA. We have to take away DA, and then we get EBIT. But we don't have any I, so that gives you EBT. We don't have any T, that gives us earnings, period. Now, as a regular old capital account, this 704B might use fair value. And then, I'm sorry about the dog. I'm going to keep going. Then, and there was an ITC adjustment, investment tax credit adjustment. Okay, sorry about the dog. Now, we can focus on I'm going to focus on the capital account, and I'm going to focus on the tax investor, because they're the ones who want the tax benefits, and they're the ones that are at risk of losing it. And here's what happens. When you have a tax depreciation, it causes a big decline really fast, because the income is negative. If the income is negative and the dividends are positive, not dividends related to the depreciation itself, just operating dividends. If they're positive and income is negative, capital goes down, equity capital goes down really fast. You have some dividends that reduce it, some losses that reduce it, and if you haven't put that much in, it can go down to zero really fast. Now, this 704B regular old account, this is so painful. It's hurting me right now. But, some people say it's book income that you use, and some people say it's tax income. And you look at actual models, and they're different. I'm going to show you that in a minute. Okay. And this is getting to be repetitive. Outside basis is the tax basis. That's what I'm going to start with, this thing called the outside basis. It sounds so confusing, it's unbelievable, really. Okay, and if this outside basis, which uses tax depreciation, it's basically just an equity capital account using tax depreciation. It goes up and down each year, just like you do with anything else. And for some reason, they also have this IDC adjustment, which kind of means that it doesn't exactly, you have to do something on the income statement with that ITC adjustment to make the balance sheet balance. But let's get into this. So this is here. This one is they call it the 704B regular account. And notice a couple of things here. First of all, they have a beginning balance and an ending balance. The investment is how much you put into the company. The distribution is how you take out, and they have all this other stuff. ITC tax basis reduction, that's not that hard. Minimum gain chargeback, 0. Uh, Income before reallocations. Provisional balance. Change in minimum gain. That's only used if you have debt, so take that one out. And then they have income or loss reallocation. But look at this one that's outside basis. That's a little bit simpler. They have how much you put in, your same kind of ITC thing. Change in project debt, take that out. Preferred distribution, you can take that out. Or, if you have a time-based flip, maybe leave it in. Cash distribution, 731 gain. That's the same as this. As you kind of add it and subtract it when this becomes negative. That's a capital gain that I'll talk about later. And then they have the really important things, which is loss suspended. So that's one example. I found this one on the internet. Okay, then I found another one. Look at this one. Oh my God, look at how many more lines these have. This is the tax equity investor, no debt. They still put minimum gain probably, even though it's no debt. And this is the regular old account, and this one has a DRO, a deficit restoration obligation. I'm going to talk about that. Notice that this DRO equals the cash distributions, by the way. Okay, and then they have some income reallocations. All right, but this is the outside basis. There's 2 ways to get this account. This is the one where you just compute the tax depreciation. You have the cash distributions, the contribution, not so hard. At first, it was so intimidating for me. Losses and gains differently for some reason. Stop loss reallocation from tax equity investor. Now, that's a confusing one. I'll get back to that. Loss allowed, and then the suspended loss. That is the key. Suspended loss is the key. If you have a suspended loss, that means you do not get to use all the tax benefit. That's the only thing in this whole thing so far that really affects cash flow. Now, here's another case. This is so horrible. They did this on an annual basis, even though the taxes are computed on a quarterly basis. And they're supposed to be some hotshot modelers. And then they didn't use this stuff anywhere in any IRR calculation, so it was just like an attachment to the model at the end. But notice this one, in the 704, this is not the outside basis. This is the, I don't know what to call it, 704B, I can't call it anything else. They use book income. And then they have some kind of, I hope they have a reallocation here. Interim balance, income reallocation. Okay. But then this is Class A, which is, Class A is the tax equity investment. We have to make things all confusing, But this isn't so bad. It's how much you put in, how much distributions you get back, a little bit of adjustment for the capital gain, and then they have this famous suspended losses here. This is what I'm obsessed about right now, because you can't use this. So you could use this right here. They had where's some tax loss? Negative partnership income. They could use this, and as soon as they get here, they can't use all of the loss. Okay. Notice it's a little bit different than the balance here. And then here's another model. Look at this. And this was just one of many. Sum ifs and divide by a if and then a sum if. Oh my gosh, and you're supposed to figure this out. And if somebody else is taking over the model, oh God, what hell? Okay. So I'm going to talk about modeling the outside basis. And that whole idea is here. This is just a clip I made. Look at this. It's some actual thing where investors are supposed to get the real tax benefits. Okay, with some kind of other partnership. Okay, and they basically said, you didn't have any real risk. Okay, now these suspended losses that I'm temporarily obsessed with, you cannot allocate. I'm reading this losses. You can't get the tax equity investor, I should say, the tax equity investor below zero. This other one, 704B, maybe it's book, maybe it's tax. This thing had a book here for 704B. This thing had a book losses, book income. Uh, this thing, I think, had a tax one, and this thing had a tax one. Who knows? Oh my God. Okay. And then you supposedly can, if you have a loss, you can carry it forward, kind of like a NOL balance. Not so hard there, really. Okay, but if you can't use the tax for a long time, that destroys the whole thing. Okay. So one thing we can understand is that this outside base capital account, just an equity capital account, if this goes negative, that limits the tax investor's losses. So you have to focus on the tax investor and focus on the outside basis and see if it goes negative. Finally, we have something that really affects cash flow. Finally, okay? And here I suggest don't mess up the model with so many other accounts. If you really understand that this is the real problem, model this one. It's possible that the other one could cause a little bit of a problem. Okay, but you've got to understand where the problem really could lie. And I've read all this stuff, and nobody tells me, it's the outside basis and it's the dividends. And now here is the real modeling problem for me. If you have a time-based flip, I'll tell you in the next slide, it's not very bad. If you have a flip transactions, when it's a yield-based flip, an IRR-based flip, the question is, if we have this suspended loss, should that be part of the computing the tax income for the cash flow for the equity partner? Or should it be kind of just independent of the whole yield flip calculation, and at the end of the day you kind of say, tough, here's your tax return, you couldn't use it all, you should have figured it out. Okay. If it's kind of like a tax rate change, who should be, they have, this is apparently what's happening now, they're talking about changing the tax code, and if they change the tax code, they could change the way the flip works. You could have the flip change later, because if you got a higher tax rate, the deductions are worth more. I almost said of course. Now, let's show you how this capital account works. So part of this is just accounting. It's just equity capital accounting. And instead of getting all complicated, I'm going to show you, we're going to make a simple little account. It's not that simple. We're going to compute this loss, and then we're going to see if we can get back this loss. And just that simple thing will illustrate kind of some of the issues. So I'm going to go and do a little bit of Excel. And just like the other ones, I made an exercise. I need to color this yellow, I guess. And in this exercise, I'm going to do it one without it. Now, in this case, I did it. I mentioned this issue that I'm going to come back to. I'm going to compute this is almost the same as in the last video. We'll compute the flip, but this time I have a depreciation account. Instead of having two cash flows, I put a depreciation. I used VBA. And I said, well, no, VBA, that's, oh God, I'm losing it. Variable declining balance, sorry. And this says, okay, I'm going to use only 3-year life. So I made a really extreme tax calculation. And notice that the PTCs, they don't affect the PTCs. They're not here. That's after you get the taxable income. That's kind of a trick. The tax credits, and we can change this maybe later. And then we need income. So this is kind of like our income statement. Okay, so income is the EBITDA we have. I should call operating cash flow. That's really just the EBITDA. Okay, suppose that you could have a little bit of working capital to mess things up. and then you compute the income. That's what you need. In a time-based flip, you don't have to compute these taxes. The only reason you need these taxes is to get this tracking account working, because you have to convert this income into you have to convert the income into cash flow now. And we need that cash flow to get this yield, this tracking calculation. Now, you could say this. What happens if the tax rate changes? You could do that. You could you could say, well, that's beside the point. We're going to, all we have at the partnership is the income level. Sorry about the dog. Just a second. No. Oh, okay, dog's barking less now. Okay, so I have to collect my thoughts for just a minute. This tax is only important in the yield-based transaction, and it's only important for getting this cash flow. I'm repeating that so much because you can also say, well, all this suspended loss business, well, that's at the partnership tax return level, so who cares really? It shouldn't affect all of this computation of when the yield occurs. They have to make sure that they're covered, and they have to do that kind of separately outside of the partnership. This is the philosophical issue. So we have some taxable income this time, and now we get the tax cash flow from the taxable income, just multiplying it by 30%. And then we get we use the minimum calculation, just like was done in the last video. There's only one exception, and that there's a little true and false, because if you have a negative balance, you need this little true-false opening switch, was a real pain. When the opening balance goes down to zero, you zero everything out. Okay, otherwise you can get some negatives that start pushing it back and changing things. Okay, and the rest of this is just like before, and then we get down, once we do all of this, we start with our equity balance. We have the sources and uses of funds account up here, where we have the equity investor and the sponsor. I put a smaller amount of tax equity in this one. And then we have the opening balance, and then we get the income. No tax here, just the income. And then we take away the dividends. Normal old equity account. And then we have this time they have a subtotal. Sorry about that. But you can put subtotals in the equity account. And then you test if this subtotal is negative with a little bit of a maximum zero count. Now I'm going to do that in the next, we're going to go through the exercise. That's the only thing you have to do. And then you might recover this suspended loss, and that's almost like a tax loss carry forward, where we say we have an opening balance, we see how much we lost, and then we use a min-max to get how much we can put in this thing. And then when we're finally finished, we can say, well, how much tax was suspended, and multiply that by the tax rate. And finally say, okay, here's what the IRR on our tax investment would be without these suspended taxes, and here's what it would be with them. Now, you've got to be a little bit careful here, because the only way, once you get down to zero in an account here, the only way to get it back up is if you get more income allocated, and this income allocated is all derived from all of these percentages. And here is the year of the flip, okay, and we need to put these percentages by year in this one to get this account working. And then we use another min-max. So even if you've never dreamed of using this and all this, you can see how some of this min-max works, and I'm going to kind of go through it now. So I should have also, I think, I should have also put this as yellow, because, so here's our exercise. because it's a little bit of a pain to do. So I'm going to start with our income distribution. And we go and see how much of the income distribution this percent. Oh, no. And we only care about the tax equity. Don't muck it all up with all these other accounts. Okay, so let's only look at the tax equity, and let's see how much of the total income, here's our total income, how much goes to the tax equity. And I'm really, this time I'm unfortunately going to use the tax cash flow. So these people get this one and this one. And then you divide it by the total. That's how we can get our percentage. And we'll do the same thing. I didn't have a divide by zero here. And this is the operating income, the operating dividend, and we need that when we look at the total dividends, I believe. So this is, I'm sorry, I said I believe there. This is the cash flow to the tax equity, and then I put the post flip there, and we divide that by the total. So that those are our, and we need this kind of middle one where it all flips. And why don't we just change the tax equity? Let's make that 900 for now. Okay, so the flip occurs later and all this stuff. Okay, and this one again, we needed to get this to zero because I needed to multiply the pre-flip cash flow by this true and false switch. That was a little pain. It really was. And I don't know, I don't think I needed to do it here. Yes, I did. We have to switch it off when we get to zero. No more pre-flip distribution when the opening balance is zero. That's all that says. Maybe that's almost too long as a function, but you need that one. Okay, so let's start with our closing balance. Always start any account with the closing balance. And I'm just going to get that from the sources and uses, as usual. And then this is kind of just a balance sheet, an old-fashioned balance sheet account. Opening balance equal closing balance. And then we take our total taxable income this time, not the tax, and multiply that by a percentage. And then we take the total dividends we're paying, which is all the cash flow, and we multiply that by the percentage we're getting. And then that's kind of like almost our finished account. We add the income, which is negative, subtract the dividends. And our account, oh no, it went to zero in the very, very first year. You know what I'm going to do? I'm going to change a few things. I'm going to make this a 5-year tax depreciation. First thing, 1, 2, 3, 4, 5, Control R. And then we have a little bit of positive. And how about we'll make the tax investor put 1,200 in. Okay, make it a little different. Okay, so we don't go down to the very first. And then if this is negative, which means we put a maximum and a minus of this one or zero. We only do it if it's negative. You use the maximum when it's negative. Max when it's positive or negative test. Min to cap an account. And then there's a little bit of tricky thing. We're going to get, if we actually get a repayment, we're going to see if we can recover some of this loss later on. It's like a tax carry forward. And then we have this subtotal, and we'll add how much loss we took and subtract the gain, because the loss just means you couldn't take it. It's almost like modeling a default. So what happened is we had some suspended loss here, and then we went down to zero. Okay, and so far I didn't put any back, but the good news is this account was then coming back up. Okay, and then we'll do the suspended loss, kind of like an NOL. So hopefully this isn't so bad. And then you put the suspended loss in that you have, and then you can only recover this one, first of all, if you have some positive subtotal. Just a minute. Let's put the closing balance before I do that. Plus the suspended loss minus the recovery of the suspended loss, okay? So let's just get our balance. That's the kind of way to do this. And then the amount we would use in this case, and this is how I really would do it, is this 177. So if this is negative, we're not going to use it then. We're only going to use it then, and we're going to use the maximum extent, which is our opening balance. So it's just like one of these things. So you put, I will put a maximum of this or 0. That's the first thing. And then, well, we don't want to do that because we want to use the minimum of this or the opening balance. And that's how easy it all is. Okay, and then Shift Control R, and then, so now we're able to use this account, and it goes down to 0, and we're able to put these things back in. So, it's a much, much shorter account. I'm out of breath. It's a much, much shorter account. But that's kind of how you model it. Now I put these things in, and now a tax investor is getting a really, really low return. That's unacceptable. And you know, I'm going to stop here because I have to just add up the accounts. But this is, in this case, this is the tax investor with the account, without it, the suspended loss, and with the suspended loss. Okay? And you can now work through that exercise. That's the idea. Now, I'm not quite finished with this. Okay? And I'm going to keep going on this video because I want to finish this so badly. Okay, here's just a note. This PTC wasn't in the calculation. Production tax credit. Production tax credit. It doesn't affect income. Income is the only thing in there. You just have to remember this is an equity account. And if you get this thing, if you get this in this one, here, let's try this. Now, let's say that we're not going to allocate the sponsor after this flip any kind of income. And if you, in this case, I got it backwards. We're going to allocate the sponsor all of the income for some reason afterwards. And then the tax equity gets no income, and they don't like income later on because that affects their cash flow. And they're never able to reverse the suspended loss because you need a positive income more than the dividends to reverse it. So we have a suspended loss here. I guess this, I don't know what occurred. It could for kind of forever. And so the IRR was pretty good, but it killed, the suspended loss killed you. Okay? So I'll put this one to 30 again. And in this case, there's this. Now if I put this to 40, how about to 50, to 70, and I'm trying to make it kind of to 80. It's got to be 75 because that's the one on the bottom. Then we have a suspended loss, but we can never ever recover that suspended loss. All you have to do is think about the equity account again and again. I'm repeating a little bit here. Okay, but it doesn't. It's once you do it with a simple example, so it doesn't get so horribly confusing. Okay, now here's some of the implications. You can say that, well, this suspended loss we just looked at, that should be in the flip calculation. Or, here's the philosophy. You could say, no, that suspended loss, this stuff right here, that's the responsibility of the tax equity investor. So should you include it in computing the flip or not? The idea of, and that's the hard part. That's the difficult part. The modeling part is difficult. If you would say, no, we up here we have some of the tax cash flow, but that's not our real tax cash flow. Our real tax cash flow is down here. It's adjusted for the suspended loss. These terms are driving me crazy. Okay, so You could say, no, just negotiate these things and give me a high enough return before the suspended loss so I can accept the suspended loss. That's what you could do, or you could put it in the flip. And nobody kind of tells you which way to do it, or I haven't found anybody who tells me which way to do it. I presume that's something that you negotiate. But you could also say, that the investor, the tax investor could have an NOL after 2008 or something, or if there are changes in the tax rate, like I already talked about, they should be in the yield calculation. They shouldn't be in the just below the line or whatever you want to call it. And the same thing with this thing I'm going to talk about, whether these dividends are treated as taxable gains or excluded from the taxes. Okay, and then I've got some other notes on the suspended loss. If you have a negative outside basis, then you should suspend the losses, blah, blah, blah. Now I'm going to do one more exercise. And in this, I'm not going to do an exercise. I'm just going to show you. If you put a suspended loss into the calculation, the basic thing you have to do is put all of the suspended loss down together here. You get the distribution, all the model is the same, but then when you get down to the taxes, you adjust the taxes for the suspended loss. And then these taxes up here, that what goes into the yield calculation. That's what goes into the tracking calculation. The thing from 59, this thing, it goes, that one, not the other one goes in. 59. And then it creates a massive circular reference. And I put a copy paste in here. So I'm going to just leave this now. And this is a little bit a better way to protect the tax investor, I guess, because the flip occurs a lot later. Now it depends, of course, on, if you have 99% of the cash flow and you haven't flipped the thing, and now you're into a time where you got positive cash flow, that doesn't really help. And then if you don't have much allocation of the dividends anyway, here, you have to have more dividends to be in the pre-flip than the post-flip for you to get this benefit. So there is a tax risk. In the first video, I was moaning about this. Now, enough of the Excel. I'm going to finish this video. You can turn it off. I'm going to talk about capital gains, Section 31, DROs, and some other things without doing much Excel. Okay. Now, okay. If this is dealing with these things called capital gains, if the capital account on this famous outside basis goes to zero, if you get a cash distribution, somehow this is called an excess cash distribution. This is saying, we're getting more capital back and we have no investment left. And for taxes, you call that a capital gain. Okay, and the dividends are not normally taxed, at least from the corporation's perspective. People pay taxes on dividends, but corporations don't. But there is this exception. If you get these dividends from this partnership and you have no equity capital in there, then you have a capital gain. And again, this capital gain basically is, you can say, should we put this fact that you have to pay taxes on the dividends, should we put this into the yield calculation or should it be outside? Once it's outside, it's not so bad because then you can just go through and compute these things. And you just put a little bit of a test in there. Okay, and you just put, if you're paying a dividend after the capital goes down to zero, then we have to pay a little more taxes because that dividend gets taxed. Okay, and here's some more things about this. Okay, and it says, this one says, I think one of them says, if you have the production tax credit, I hope this one says, no, the production tax credit will be similar to the distribution. It might get taxed, okay? Then now we have this other capital account. Just to make things so horribly confusing, I just went through a capital account. And when I introduced it, I said, oh, no, 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 there are two capital accounts, not one. And you have to test both of them. Oh, God. Okay, and this other capital account, they say, well, that's kind of a normal capital account. I put book basis. Well, I don't know if it's really book basis. That's why I call it 704B. I don't even know what to call it. Okay, so there are a couple of differences between this account. And the real thing you need to know is which constraint is likely to cause the problem where you have the tax investor not being able to use this. So instead of babbling all about this, you need to know what's the real effect of this stuff. Now, I call this kind of a I don't, somebody else said, you just add the capital just the way you did, okay, and whatever. So here's an example. This is the one I took before. They don't say here whether the income, where's the income? Investment, preferred distribution, cash distribution, income chargeback. Income, this is clearly a tax loss. This has tax depreciation in it. Okay, some people said no, it's book depreciation. This one again has tax depreciation in, but this one, you notice this time they have this stop loss reallocation, and this one has two different accounts, and maybe that's why you need it. This is the sponsor or developer account. This is the tax investor account. Everybody uses different words, and this one, in this case, the account went to be negative out here. It was negative for this one. And when it went to be negative, then you took some income from the sponsor and you reallocated that. So this is the bad news for the tax investor. They want the I guess, hang on, where's the negative taxable income? If the taxable, well, if this is positive, then it's not so bad. But this, uh, if the tax investor cannot use the taxable income, then it's a real thing. It's kind of like that suspended loss. Okay, and so they have these stop loss reallocations. I hope you kind of see if it gets allocated from one partner to another, but that's not in the other one. That's not in that outside basis thing. Maybe it's called not outside basis because you have these movements between one partner and another partner inside the partnership. Maybe that's why it's named this. Okay, and when you know, this one is where it says you can drag the production tax credits along. So if you're not able to use the taxable income, then you also have to allocate the the tax credits. So that can be very, very painful. Now then you have this horrible deficit restoration obligation, DRO. Everybody says DRO, DRO, DRO. What is it? It says the main way to deal with an absorption is for the tax investor to agree to make a capital contribution when the partnership liquidates. They're not putting any real money, no tax, nothing is allocated except this is just kind of a promise that when we finally are finished, we're going to restore things. I don't know how better to say this. And I'm just kind of copying things that I got. Okay. So when if you have this famous 704B thing, you can use you can have this kind of hypothetical thing that gets only paid when the partnership finally finishes. Okay. It doesn't apply to this outside basis, which is the one I just showed you. So this DRO is only on the one account, not on the other. Okay. After the tax depreciation is finished, everybody gets income. Okay, that doesn't mean you get to increase your capital account because it also depends on the dividends you have. We just showed you that in that example. Okay, and this DRO, they agree to this thing when it liquidates. And the question is it real obligation or is it some funny money? Somebody said, no, 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 it's real. It's very real. I don't know when it's real. I guess when you actually sell the project, then you'd have to put some money back. You'd have to give some money back to the tax investor because you agreed to that. And some people don't like to agree to too much of it. And if you don't like to agree to too much of it, you fall into this other problem. Now, here's an example. I'm just trying this with a real model. And when we have an actual cash distribution, here, this is the distribution. This deficit restoration obligation just covered the distribution. It didn't cover this one. And then there was a stop loss reallocation that was the real problem. So you really, I suppose you might have to put two capital accounts to understand whether this is the problem or that is. But at least you have to understand it just a little bit. And it's painful. And then you have to understand in a yield-based thing, are you going to put all these constraints in? That makes the circular reference and the problems enormous in a way. Now, I'm not finished. There's this thing called hypothetical liquidation at book value, but this applies to GAAP. As soon as I say GAAP, I say, it's accounting. Let's leave it alone for now because it's not tax. Okay, and then there are some other descriptions. I'm just going to put this PowerPoint slides, which all I did is kind of take some stuff from the internet and some other things I received and try to put things together, and there's some more issues. And then we have debt at the project level that I didn't really put in. And if you see this thing called minimum gain, it's, I didn't finish this, but it's a term related to the debt. And if you have debt, that affects all of these constraints. It's not only and when I say debt at the project level, so the debt, it doesn't only affect like cash flows and waterfalls and all that stuff and who gets paid first and who gets paid second and all that. It affects the constraint because you have to adjust these depreciation calculations from the changes in the debt balance. And I'm not even getting into that one because a lot of these projects don't have project level debt. Some of them have this fancy thing called back lever debt. Oh, how fancy that is. That just means you've got subordinated debt. That means the the equity and sponsor investor, or I suppose it could be the tax investor, but mainly the sponsor investor just gets some old debt. It's like getting your own personal debt after but that debt is covered by dividends from the partnership. So whether you should include it or not, it's kind of like double leverage or something. And then I put some notes on leaseback transactions. And I'm not going to go through this in the video. I think this is enough. All right, so that's enough. And I hope that now I have covered things in a more comprehensive basis for all this tax allocation stuff, or this tax equity stuff.